Ever wondered what really goes on inside a hedge fund? Not the huge, multi-billion-dollar giants, but maybe a smaller, really nimble, effective one. Well, today you're kind of getting a backstage pass. We're doing a deep dive into the inner workings of a hedge fund team, specifically looking at one managing around $100 million. And our guide for this is this really interesting piece detailing the key roles and how they all, connect. It's structured around the actual operational flows that make a fund like this work.
Yeah, and our mission today really is to get under the hood and understand how a fund of this particular size balances that deep specialized expertise with the agility you need to adapt to markets that change so fast. It's all about creating this lean but seriously effective team structure. We'll explore the who, the what they do, and crucially, how they all interact to drive those investment decisions.
Right. And this isn't just like dry finance stuff. It's about seeing a highly specialized group optimize for efficiency, for insight, all within this very specific, high stakes environment.
Okay, if you're ready, let's unpack this. Okay, let's start right at the top. For a fund this size, around 100 billion, the leadership. It's often pretty concentrated, right? Who's really at the peak, making the final calls, and what's maybe different about their role compared to a massive fund?
Well, what's fascinating here, and pretty common in funds of this scale, is that the chief executive officer, the CEO, often is also the chief investment officer, the CIO. They wear both hats. So they're the ultimate decision makers. They set the long-term vision, the investment strategy, how risk is managed, the whole operational side. This dual role, it's kind of a hallmark of these smaller, more agile funds. It means you've got one person really embodying both the strategy and the core investment thinking. Leads to incredibly tight alignment. Okay, so that top-level direction is set. But then how does a fund like this actually find its investment ideas day to day? That sounds like where the scan and signals team comes in. They're like the fund's radar system.
Exactly. They're the idea generation engine, constantly sweeping the markets.
And their job is basically to spot potential opportunities, trends, anomalies across all sorts of assets.
Yep, everything. Equities, fixed income, commodities, currencies, even derivatives. They're looking everywhere.
Now, you mentioned lean teams. How lean are we talking for this scan and signals function?
Typically pretty lean, maybe just 2 or 3 people. But what's really insightful for a fund this size is how they blend different approaches. They absolutely have to combine that systematic quantitative power with more nuanced macro or fundamental insights. See, with 100 million, they can't just chase every little blip on the screen, right? Their edge comes from efficiently finding those higher probability opportunities that maybe the bigger, slower funds might overlook.
Okay, so who are these 2 or 3 key people then? What do they actually do?
Well, you'd almost certainly find a lead quantitative researcher or maybe a data scientist. This is the person designing the systematic scanning processes, building the quantitative models that generate the signals. They're using techniques like statistical arbitrage, looking for those tiny fleeting price differences, factor models, maybe even some machine learning to spot patterns in the data.
Right, so these are the folks with the heavy-duty programming skills, Python, R, MATLAB, dealing with enormous data sets. They're building the funds like digital eyes and ears.
That's a great way to put it,
Yeah.
And then complementing them. You usually have macro or fundamental research analysts. These folks do the top-down analysis, global trends, central bank moves, geopolitics, and also the bottom-up, company-specific research. They're looking for those qualitative signals. This blend is really important because a purely quant signal might tell you what's happening, but not necessarily why. You need both.
So the team takes in all this data. The quant models generate potential signals like momentum or mean reversion, weird volume spikes. And then the qualitative analysts kind of validate or add context.
Exactly. They work together. The end result is this curated list of potential opportunities, not just raw noise. And that gets passed on.
Passed on to the next stage. So scan and signals finds the raw material. Now you need someone to decide what to actually do with it.
Right.
To separate the real gems from, the rest.
Precisely. And that's the job of the strategy team. Think of them as the architects.
Their goal is to take those signals and turn them into actual deployable investment strategies.
Yep. They evaluate the signals, develop a specific investment thesis for each potential trade, define really clear entry and exit points, and, crucially, assess the risk versus the potential reward.
Okay, and is this team bigger, smaller?
Often even leaner.
Yeah.
Sometimes just 1 or 2 people. And remember that CEO, CIO, they usually play a really significant hands-on role here too.
Makes sense.
The key figure is often the lead portfolio manager. They're synthesizing the signals from the research team, deciding on the investment horizon, the target return, how much risk is acceptable for this specific strategy. They're the main link between the research ideas and actually putting money to work.
And that raises a key point for a smaller fund, doesn't it, with limited capital? How do they balance conviction, really believing in a strategy, with, being cautious? That must be a constant tension.
It absolutely is. It's a critical balancing act.
So how does that play out? Is it all about rigid rules, or is there more of a culture of, debate and challenging ideas?
I think it's a mix, but that culture of challenge is vital. They can't afford groupthink. Their process involves really digging into those signals, building out detailed investment theses, outlining the catalysts they expect, the price movements, the time frame, and then rigorous scenario analysis. That means quantifying potential gains versus potential losses, looking at volatility correlations. They might even assign probabilities to different outcomes. It's a deep dive into all the what-ifs.
So they really stress test the ideas.
Exactly, to make sure the strategies are robust before any capital gets allocated.
Okay, strategies are refined, they're ready to go. Now we get to the point where ideas actually become trades in the real world. This sounds like the allocation, position sizing, execution, and monitoring team, turning plans into action.
You got it. This is where the rubber meets the road. Their objective is threefold, really. 1, decide the optimal allocation across the whole portfolio. 2, size the individual positions based on risk tolerance. And 3, execute the trades efficiently, and then constantly monitor performance and risk.
And the team size here, back to maybe 2 or 3?
Typically, yeah. You'll have a head of trading or a dedicated trader. Their job is efficient, best execution, managing broker relationships, watching market liquidity, making sure they can get in and out of positions smoothly.
Crucial.
But just as crucial, maybe even more so, is the risk manager or portfolio risk analyst. This person develops and implements the fund's entire risk management framework. They're the watchdog. They monitor portfolio-level risks, things like FARR, value at risk.
Right, the maximum potential loss estimate.
Exactly. And stress testing, seeing how the portfolio holds up under extreme market conditions. Concentration risk, making sure they're not too exposed to one single thing. And critically, they provide independent oversight.
That word independent seems really important, especially in a small team where roles could potentially blur. Is it culturally difficult to maintain that separation, or is it just accepted as essential?
Oh, it's absolutely essential, and usually very well defined. It has to be. These risk managers are key for setting position limits, hard stops, and often they report directly to the CEO, CIO, bypassing the portfolio managers to ensure that independence.
So they have real teeth.
They have to. They're the fund's internal brakes, the safety net.
Okay, and then there's someone keeping all the trains running on time behind the scenes.
Yep, the operations and middle back office analyst, often unsung heroes. They handle trade reconciliation, making sure trades match up settlement, portfolio accounting, calculating the NAV.
The net asset value, the fund's per share value.
Right, and compliance reporting. All the essential plumbing that needs to work perfectly.
So what's the flow here? Allocation decisions get made.
Based on the approved strategies, but with critical input from the risk manager on the overall portfolio constraints. Can we actually take on this new position given our existing risks?
Right.
Then comes precise position sizing, how much capital goes into this specific trade. The head of trading executes the trade. And then in real time, positions, profit and loss, P&L, they're all monitored constantly. After the trade, the ops team makes sure everything is recorded correctly, settled properly. Regular reports on performance and risk exposures get generated. And here's the crucial bit. Those results, especially things like unexpected risk concentrations or maybe execution that wasn't great, that information feeds back.
Back to the earlier teams.
Exactly. Back to the strategy team, back to the scan signals team for continuous improvement. This feedback loop is absolutely essential. It's what makes the fund a living, adapting system.
Like an organism learning from experience.
Precisely. Without that constant flow of information, post-trade insights feeding back into idea generation and strategy refinement, a lean fund like this just couldn't stay competitive or agile. Markets change too fast.
Makes total sense. Now, this core internal team sounds incredibly focused. But $100 million, while significant, isn't enormous. They must rely on outside help, too.
Oh, absolutely. They strategically leverage external support. It's smart business, manages costs, gives them access to expertise they might not need full-time in-house.
So what kind of functions do they typically outsource?
Key things. like a compliance officer or external legal counsel. Regulatory stuff is complex and vital. You can't mess it up. A fund administrator, they provide independent calculation of the NAV, handle investor reporting that independence is important for investor trust.
Right.
Auditors, of course, for the annual financial audits. Prime brokers are huge. They provide financing leverage, clearing services, custody of assets, and often really sophisticated trading technology platforms.
So they're more than just brokers.
Much more. They're critical infrastructure partners. And then usually dedicated IT support to manage their tech infrastructure, cybersecurity, data management.
So this lets the internal team stay laser-focused on the core job, investing.
Exactly. It amplifies their efficiency. Get the big fund capabilities without the massive internal headcount.
Okay, so we have the internal teams, the external support. What holds it all together? How do they ensure everyone's on the same page?
Yeah, the glue is robust inter-team communication and collaboration. It sounds obvious, but it can't be left to chance. It has to be deliberate.
How do they make that happen practically?
Well, typically regular investment meetings. Maybe daily, maybe weekly, involving all the core investment folks, quants, macro analysts, PMs, the CIO. They discuss the market outlook, review new signals, debate strategies, make allocation decisions together.
So structured interaction.
Yep. And then using dedicated communication channels, Slack, Teams, whatever, for quick updates, sharing articles, fast back and forth, clear reporting lines help, knowing who's responsible for what, and key performance indicators, KPIs, to track how different parts of the process are doing. But honestly, what's truly vital are those continuous feedback loops we talked about.
That seems to be a recurring theme.
It has to be. Ensuring insights from execution, from monitoring, from risk management directly flow back to refine how they find ideas and build strategies in the future. It's like the fund's circulatory system, keeping everything healthy and responsive.
Okay, so pulling it all together, what does this mean for you, our listener? We've kind of peeled back the curtain on a $100 million hedge fund, and it's not some sprawling, faceless corporation, is it?
Not at all. It's surprisingly lean, highly specialized, and deeply interconnected. It's really a masterclass in focused expertise, these really well-defined operational flows, and those critical feedback loops. Every single role, from the data scientist digging for signals to the risk manager enforcing discipline, they're all linked, all vital.
Yeah.
It just powerfully highlights how efficiency and deep understanding are absolutely paramount, especially when you're not managing billions. You have to make the most of every dollar, every insight.
And the beauty really seems to be in that detailed flow, that process. Seeing raw data become a signal, then refined into a strategy and executed precisely and constantly monitored. It's this continuous cycle.
A self-improving cycle, ideally. And that structure really emphasizes discipline, but also adaptability, which, let's face it, are non-negotiable in today's market. Which leads to maybe a final thought. Given how fast markets and technology, especially things like AI, are changing, what do you think might be the next essential role or the next critical team flow that funds of this size will need to develop to stay ahead in the next few years?
Will AI make teams even leaner? Or create entirely new roles we haven't even thought of yet?
Exactly.
Definitely something to ponder as you continue your own deep dives into complex systems. Until next time, keep that curiosity alive.